What is the PEG ratio, and why is it better than PE? Imagine you're trying to figure out if a stock is worth buying. You look at its price compared to its earnings, but that alone might not tell the full story. That's where the PEG ratio comes into play. The PEG ratio, which stands for price earnings to growth ratio, takes the traditional PE ratio and adds a twist. It divides the PE ratio by the company's expected earnings growth rate over the next 1 to 3 years. This way, you're not just looking at how much investors are paying now, but also considering how fast the company is expected to grow. The PE ratio is simple. It shows how much investors are willing to pay for each dollar of current earnings. You get this by dividing the stock price by earnings per share. But here's the catch. A high PE can mean a stock is overvalued or that investors expect high growth. Conversely, a low PE might suggest undervaluation or slow growth. Without knowing the growth prospects, the PE alone can be misleading. The PEG ratio improves this by factoring in growth expectations. It is calculated by dividing the PE ratio by the expected earnings growth rate expressed as a percentage. For example, if a stock has a PE of 20 and the earnings are expected to grow at 10% annually, the PEG ratio would be 2. A PEG of 1 indicates the stock's price fairly reflects its growth potential. A PEG above 1 suggests overvaluation relative to growth, while below 1 hints at undervaluation considering future earnings. From a market analysis and strategic trading perspective, the PEG ratio helps investors and traders distinguish between stocks that look expensive because of high growth expectations versus those that are genuinely overvalued. It allows for better comparison across different companies and sectors with varying growth rates. For options traders, understanding the PEG ratio can guide decisions around earnings announcements or growth-driven price movements, reducing the risk of misjudging a stock's value based solely on current earnings. In essence, the PEG ratio offers a more balanced view by combining current valuation with future growth prospects. It helps you see beyond the surface and make smarter investment choices. That's why many consider it a better tool than just the PE ratio when analyzing stocks for trading or long-term investing.